All right, good evening, everyone. Just a quick sound check. Before we get started, can everyone see my screen and hear me okay? If you could just drop a Y or a yes into the chat box, that would be great. Okay, can everyone hear me okay? I've got feedback from JComp. Thank you, JComp. He says yes. Okay, Nabil, yes. Judy, yes. Fez, yes. Thank you. All right, so where is everybody joining us from tonight? Where is everybody joining us from tonight? Fez is in Germany. Good evening, Fez. Judy's on Australia. Good evening, Judy. Nabil's in Dubai. Good evening, Nabil. Comp is in Michigan. Good evening, Comp. Phil is in Australia. I'm starting to see a theme. Good evening, Phil. Starting to see a bit of a theme. I think we've got a lot of people from Australia. Yep, some more from Australia. Graham is from Australia. Good evening, Graham. I recognize you. Mind you, I recognize a lot of you. So welcome. Thanks for joining us tonight. I appreciate it. I'm just going to get started here. I know we're probably going to have a few other people joining us, so I'll just have to keep an eye on the entrance to allow people in. So if I pause a couple of seconds once in a while, don't be alarmed. Okay, so it's great to have you all with us tonight, and welcome to the strategy session of the Mountain Trading NDX Momentum Strategy. So let's get started. So sorry for the disclaimers right at the start, everyone, but it needs to be said. Trading and investing can contain significant financial risks. This presentation and all references are subject to the disclaimers as posted on our website at www.systematic-investors.com. Please take a moment to visit and read through the disclaimers on our website before considering use of our services. All traders and self-directed investors are always responsible for managing their own risk and making their own final decisions. So please use all information presented at your own risk. We're going to be talking about some trading ideas, specifically trading strategies, rules. So absolutely use all information provided at your own risk, please. Okay, again, so welcome to the Systematic Investors Group strategy session presentation. Our guest presenter tonight is our friend and colleague, Gary Boardman from Mountain Trading Group. So Gary will be going over the rules and backtest results of his NDX Momentum Trend Strategy and the implementation that you yourself can start using to get trading ideas as soon as tomorrow morning. So let me first introduce Gary before passing the screen and mic on to Gary. Now, I've known Gary for a number of years in our local trading communities, and I can tell you he's a pretty smart dude. Okay, so a little bit about Gary before I pass the mic. Gary Boardman has a master's degree in electrical engineering with a focus on digital signal processing. Always interested in financial markets, he's been trading since the late 1990s. His technical background translated well into the world of equity markets. Gary moved all of his money to self-directed accounts about 10 years ago and started trading more actively, initially using recommendations from various newsletters and other sources. He's now a systematic trader and investor, as we are, with some great things to share with the Systematic Investors Group community. Gary has been investing for 20 years, actively for the past 10. He spent the last 5 years developing his own strategies and developing his own backtesting software, which is really cool. Gary is currently trading this system with his own money live. In fact, myself and a couple of the other members in the Systematic Investors Group, some are online tonight, are trading Gary's strategy as well, and it's been quite good. He has it fully automated. His backtesting software generates the trade signals daily and sends them to Alera Portfolio Manager to execute the trades with interactive brokers via their IB Gateway API. So with that being said, just give us a second here, gang, to switch things around. So I'm going to stop sharing. And Gary, you can go ahead and share your screen. Okay,
Good.
perfect. I can see your screen, Gary.
Okay, thank you.
And just a quick sound check. I think I can hear you okay. And the level sounds
Is
awesome.
that good? Okay, perfect.
Yeah. So Gary,
Okay,
if you need me to cut in at any time, just holler. I'm going to turn my mic off, and you've got the floor. Thanks, Gary.
okay, great. As Dave mentioned, I'm going to go through my NDX Momentum Strategy tonight. I'll give you an overview of how it works and some of the performance metrics that I look at and what the performance looks like over the last couple of decades. So of course I have a disclaimer here, which is basically saying that this presentation is for information and educational purposes. And I will be talking about specific stocks, but that should not be construed as any kind of recommendation. It's basically for educational purposes. So as Dave mentioned, I've been investing for over 20 years, fully self-directed over the last 10, approximately 10. I started developing my own backtesting software a few years ago. And in conjunction with that, I was developing various strategies. Currently, I have a large portion of my net worth in equities, and about 90% of this is allocated to strategies I'll be talking about tonight. So the evolution for me took a while, but it included things such as value investing, income generation from options, and various ETF strategies. For me, the breakthrough came when I started ranking ETFs from different sectors based on momentum, and I applied a monthly rotation to those holdings. I found that certain combinations of day of the month rotation and ranking parameters produce very good results over an extended backtest period. So here are some objectives and key things I'd like you to take away from tonight. So first of all is an understanding of how the strategy works, what to expect if or when you trade the strategy, how to evaluate performance and risk, how I automate the strategy, ways to manage the emotional side of trading, and finally, how to try out the strategy and get involved in the SIG community. So in terms of the strategy itself, I'll give you a brief overview of the how, what, when, and where of the trade mechanics. I'll go through some trade examples. I'll go through how I manage the portfolio and do money management and risk management. I'll also go through how I define an edge and what risk-adjusted return is. I'll take a look at the performance metrics, take a look at the automation of the strategy, and also how to manage emotions. Okay, so how the strategy works. Basically, it uses a number of momentum indicators like rate of change and moving averages. Using these indicators, I rank stocks based on momentum score, highest to lowest. From that list, I take the top 5 on a daily basis. And those are the top 5 I use for the trades for that day. This strategy uses end-of-day data, so no intraday trading is required. And basically, the goal is to buy at a discount stocks with positive momentum that have seen a recent pullback. And by following these basic rules, we can determine what to buy, when to buy it, and where at what price levels to buy and sell. The timing and pricing rules are determined from backtesting using risk-adjusted return as my main form of optimization. Okay, so what do we trade? The strategy trades the NASDAQ 100, which is a market cap weighted index of the 100 largest non-financial companies listed on the NASDAQ exchange. The universe of stocks is updated when NASDAQ issues changes. Typically, changes to the index are made at least once per year in December, and you may see a few other changes happening during the year if acquisitions or mergers happen. I think this year there's been 3 or 4 changes to the index so far. Historical constituent data is accurate to avoid survivorship bias. So this includes delisted price data. And the NASDAQ 100 was chosen due to the availability of good historical data and the highly liquid trading of its constituents. Okay, trade mechanics. When do we trade, and where, at what price levels do we trade? Positions are held a maximum of about 1 week. Positions may be closed early if the closing price from the previous day is at or below the stop loss price. In rare cases, a position will be sold intraday if the sell limit is hit for profit. Limit orders for open positions are entered each day at the sell limit price. What price levels do we trade at? Positions are sold using market on open orders, other than the intraday sell limits. Positions are open using limit orders at a price slightly below the previous day's close. Stop price is based on the entry limit price, and the sell limit price is also based on the entry limit price. Both the stop price and sell limit price are set at a trade entry. These levels are not altered during the life of the trade, i.e. there are no trailing stops used or other type of stop loss trades. So where does the strategy fit on the trading system spectrum? I would consider this a combination of reversion to mean and momentum on the shorter term end of things. So basically it's a combination found in this box of trade types 1 and 2. Okay, so I'm going to go through a few trade examples to give you an idea of how how things work. Let me just check something here. Okay. So for example, a winning trade. This example is Zoom Video Communications, which was bought on July 30th. What I want to point out here is the yellow arrows show the trend. So the Zoom was in an uptrend, and it had a recent pullback. So based on that, a signal came through to buy on July 30th. So the buy was done at about 249, which is right around here. So a little bit lower than the open. Then this trade was held for 4 days. Then on August 5th, we sold using a market on open order at 265.60. So that gave us a profit of 6.6% in 4 days. A losing trade. So in this example, we were trading BioMarin Pharmaceutical. The buy was done on July 27th at about $123. And the sell was hit on, well, the close of the bar on July 29th, I guess it is, was below the stop. So it closed at 119. Oh, sorry, it closed below 120.64. And then the next day, the position was sold using market on open order at 119.21. So in this case here, it was held for 3 days, and the loss was 2.2%, 3.2%. Also, I wanted to show you what I refer to as a re-entry order. So in some cases, we can be holding a position that gets sold at open. It could be sold because of a stop condition, or it could be sold because it's been held the maximum number of days, so a time stop. But in a lot of cases, that particular stock will still rank high in the ranking. So I will get another buy order for that particular stock, but the buy order will be at a limit price below the open, below the previous day's close. So it's possible that at the beginning of the day, so this is a 1-minute chart, at the open, in this case, this is Moderna. So at the open, Moderna was sold using a market on open order at 74.89, right at 9:30 a.m. And there was, but simultaneously there was a limit order put into the market to buy at 73.17. So at 10:41 a.m., that limit was hit. So the buy order was triggered. So we bought into Moderna at 73.17 at 10:41 a.m. And in many, as you're probably aware, you've probably seen many stocks that open and go lower at the open. And then once some buyers come in, the price will start to move back up again. So the idea here is that we capture this low entry level, this low entry price, with the hopes that it starts to trend up over the next few days. So if there's any questions or anything, you can type them into the chat box, and I'll make sure I try and take a look at that periodically. So in terms of the portfolio and money management, the portfolio is based on 5 positions, and each position is allocated 20% of equity. There really is no requirement for margin. However, this will be easier to trade in a margin account, because if you're in a retirement account where you do not have any margin available, you will have to close positions before opening new positions. In a margin account, you will be able to simultaneously close and open positions. So it can work a little more efficiently in a margin account. In terms of risk management, the strategy uses a macro indicator to determine if equity should be in the market, what I refer to as risk on. The indicator is a combination of market sentiment and volatility. So if the indicator is showing risk off, all equity is moved into a cash equivalent until the market sentiment changes. And in general, long-term bonds work well as a cash equivalent. Okay, so if we take a look at the strategy at a macro level, these are the high-level kind of behavior you'll see based on historical trading and historical backtesting. So in terms of the macro indicator, the strategy will be in stocks about 52% of the time, and 48% of the time it'll be in a cash equivalent. When it's in stocks, it's going to have about a 78.6% exposure, meaning that about 20% of the portfolio will be in cash on average throughout the period when it's in stocks. And this has the effect of bringing down volatility a little bit, because you're not going to have the 20% cash is going to cushion sharp moves in stocks a little bit. The other effect it has is that the correlation with the index, so in this case the NASDAQ 100, it'll lower the correlation a little bit because you're not exposed as much as the index is. The average trades per year is 166. If we take a look at commissions and slippage, my goal is to keep expenses below 2% of portfolio value. So if we look at a typical portfolio, let's say it's 50K in size, the median share price on the NASDAQ 100 is $125, and we're trading through Interactive Brokers. Total commission for the year is estimated at about $375 or 0.75%. So that's well below my 2% target. If using market on open orders, we effectively get 0% slippage. If you do actually trade this, you'll see that using a market on open order, you get very, very close to the opening price. And that's the idea, is that you, when you see that huge volume spike at the open, these are all the market on open orders that have been placed into the market 10 to 15 minutes before open. And the exchange actually has an auction where they set that price, a guaranteed price where you'll get filled. So if using this guideline here of 2% of portfolio value, the minimum recommended portfolio size is about $20,000 to keep expenses below 2%. Winning days is at about 57%. Winning months are 72.5%. The correlation with the NASDAQ 100 is about 29%. And in terms of volatility, I looked at two different things here. One is looking at monthly equity movements, so standard deviation. So deviation from the basically average. In that case, the volatility is about 78% of the NASDAQ volatility. If we look at something like a risk-adjusted return metric, like the Ulcer index, the volatility is about 10% of what the NASDAQ shows. The strategy at a trade level. So if we dig down to the trade level, what we find is that the number of winning trades is about 51%. The percentage filled is 54%. So of all the limit orders I put in to the market, 54% of those get filled. The number of positions that are re-entered is 23%. So about 1/4 of the positions are ones that were closed in the morning and then reopened at some point during the day using a limit order. If we look at the time in the market when it's invested in stocks, the average days held is 3.2. The cash equivalent on average is held for 58 days. Average gain of winners, 5.4%. Average loss of losers, 3.1%. Average return per trade is 0.9%. So if we look at every trade that was made and simply take the average return, we get 0.91%. And then, so the profit factor by taking the winners divided by losers is 1.73. Okay, so how to get rich in the market in 3 easy steps. Step number 1 is to use a good strategy. The strategy doesn't have to be great. Good will achieve the goal. The strategy must have a defined edge, which has been tested. Risk-adjusted return is a good way to compare strategies, portfolios, and benchmarks. And use compounding to your advantage. So you make sure you scale position size to portfolio size. Step number 2, add some patience. This is definitely not a get-rich-quick scheme. That kind of stuff rarely happens. Really, you're looking at a minimum 3-year investment horizon to see the strategy working properly and to basically filter out, the day-to-day noise that happens in the market and the various forms of drawdown that can happen, whether it's a coronavirus or an election, whatever it is. You're going to have periods where there's prolonged drawdowns that you have to basically invest through. And step number 3 is add some discipline. Follow the strategy rules and don't panic in good times or be impatient in good times. So don't panic in bad times or be impatient in good times. Now these steps sound easy, but in practice, they can be very difficult to follow, especially the step number 3. If you've ever traded through a bear market or difficult times, you know that it can be really hard sticking to the strategy. Or if you've ever traded through euphoria type situations, like the recent run-up, it can be difficult to hold on to winners when you can just cash out and take a profit. Whereas if you really want the strategy to work out in the long term, you really have to follow through with it. Okay, so defining an edge. This is why we trade. If there isn't an edge, we may as well buy an index fund and call it a day. An edge is an advantage obtained by using an active strategy, example, lower drawdowns, better returns, etc. So trading based on probability. it's impossible to predict which positions will be profitable at an individual trade level. Through the law of large numbers, it is possible to predict with enough accuracy the overall profitability of a strategy. By doing extensive accurate backtesting, it's possible to estimate how profitable a strategy will be, which can be defined as expectancy. And this is what I define as an edge. So risk-adjusted return. The best way I find to compare strategies to other strategies or benchmarks is to use a risk-adjusted return. Risk-adjusted return is an attempt to come up with a number that represents the amount of return achieved given a specific amount of risk. There's all kinds of different return metrics out there. I use a few of them, and these are the ones I find in terms of least to most useful. There's something called the MAR ratio, which is the ratio of the compounded annual growth versus the maximum drawdown. There's ratios referred to as the Sharpe ratio, Sortino ratio, which use standard deviation to measure volatility. And then there's metrics like the Ulcer index, which I'll describe for you in a few slides. Okay, so the problem with maximum drawdown. MaxDD is generally a one-time event and is not very meaningful when looking at thousands of events. An alternative is to calculate an average maximum drawdown based on 5 or 10 of the worst drawdowns. This still doesn't give a good indication of depth and duration of drawdowns. I use an adjusted MAR, which is basically the compounded growth divided by an adjusted max drawdown, where the adjusted max drawdown is an average of the 5 worst drawdowns. Another alternative is to calculate a rolling MAR based on a reasonable time period, for example, 3 years. So this is a chart of a 3-year rolling MAR, where I look at the gray line is the NASDAQ 100. The blue line is using max drawdown with the compounded growth, and the orange line is using average max drawdown. So basically this takes 3-year periods, and for that 3-year period, it looks at what the growth was, so the compounded growth, and it looks at what the maximum drawdown was for that 3-year period, and then it calculates the ratio. And then it rolls that period daily across the entire time frame. And then you end up getting a chart like this. So a few things to note. One is that the NDX goes negative in a few spots, which means that the 3-year compounded growth was negative. So during periods like after the dot-com bust and during the financial crisis, the return for the NASDAQ was negative over a 3-year period. In terms of the strategy itself, the low point was at the beginning of 2008, it was about 0.8. And the overall average for over the last 10 years has been about 2.5, which I'm very happy with. Okay, so the problem with the Sharpe and Sortino ratios and standard deviation in general. I see the Sharpe ratio quoted by a lot of different people, a lot of different funds, ETFs, etc. But it does have its shortcomings, and I'll describe what those are. So the Sharpe ratio is defined as the average return divided by the standard deviation. The idea is that the standard deviation is a measure of volatility, or in other words, risk. So this ratio will give an indication of risk-adjusted return. The Sortino ratio is a modified version of the Sharpe ratio, where instead of using standard deviation of all returns, it uses only the downside deviation, which is the negative returns over the period. So that's the volatility of negative returns only. The idea is that volatility resulting in positive returns is not a bad thing, so it's removed from the equation. Now we get an indication of risk-adjusted return, but only looking at negative returns as risk. Now the thing with standard deviation is that the order of returns does not matter. So you can have significant drawdown occur, and this will not be reflected in the Sharpe or Sortino ratio. So for example, if we look at the S&P 500 from 2002 until 2009, so over this period, the growth was 3.78% compounded. The standard deviation was 1.39%. This is a daily chart, by the way. Using those values, we come up with a Sharpe ratio of 0.2784. Now, if I was to reorder the daily returns, so it's the same returns. What I've done is I've put the lowest returns in front and then ordered them ascending to the highest returns. So you end up at the same starting point, same ending point, same growth. Your standard deviation is the same, but of course you have a completely different looking chart, and nobody in their right mind would invest in this vehicle. But the problem here is that the Sharpe ratio is the same for these two charts. So an alternative to the Sharpe and Sortino ratio is something called the Ulcer index. The UI is a measure of the depth and duration of drawdowns. It avoids the problems that you just saw with standard deviation, where the order of the drawdowns with the Ulcer index matters. The greater the drawdown and the longer it takes to recover to earlier highs, the higher the Ulcer index. So in this case, smaller values are better, and it is a very good way of measuring severity of drawdowns. And one of the key things here is that larger drawdowns have more weight in the calculation. And it's been described as perhaps the most fully realized statistical portrait of risk there is. And it's my preferred risk-adjusted return metric. So just bear with me for a second. I'm going to go through how this value is derived. So if we take an example of AC voltage in your house, the voltage coming out of that outlet is actually a sine wave with a peak of about, in North America anyway, is about 170 volts. Now, it would be nice if we could just express that voltage as a single number and be able to use that number in calculations. So what's been derived is they've come up with something called a root mean square value, which is basically a way of expressing the voltage, AC voltage, as a single value. So the way they come about this value is they square all the voltages, add up all the values, and then take a square root of the average of this waveform. So what you end up getting is this value, which is 120 volts AC. So when somebody quotes the voltage coming out of an AC outlet, they would say it's 120 volts AC, which is actually this RMS voltage value. So if we use the same concept for the Ulcer index for drawdowns, we have a drawdown curve or waveform, which is varying over time. What we can do is we can take the square values of all of these drawdowns, which produces this blue graph at the bottom. We can then add up all these values, take the average of that squared value, and then take the square root of it. And then that will give us the Ulcer index value. So the resulting value is a percentage value, which I've drawn here with this yellow line, which gives you a very good indication of what the extent of drawdowns are over the duration of this drawdown chart. And basically, the deeper and longer these drawdowns are, the worse the UI level will get. So if we do a comparison between standard deviation and Ulcer index, I looked at some various risk-adjusted return values for the original S&P 500 and the reordered S&P 500. So for the maximum drawdown, the S&P 500 original was about 57%. The reordered one was almost 100% drawdown. The Sharpe ratio for them, for the two different versions of the SPX were the same, and the same for the Sortino ratio because they're based on standard deviations. The Ulcer index for the original SPX was 17%. The Ulcer index for the reordered SPX was 97%. So clearly much worse. Okay, so I'm going to take a look at some of the key performance metrics based on a 25-year, actually almost 26-year backtest. Let me just grab my Excel file here. Oh, sorry, I'm going to take a look at the website. Okay, so this is the Systematic Investors Group website, the Mountain Trading NDX Momentum landing page. And on this page, it provides a number of different back information on these on the strategy. So that includes what the logic is for the strategy, what the backtest assumptions are, what the backtest metrics are, and various charts for things like drawdown and equity. So if we take a look at the metrics for the strategy itself, so since 1995, it's traded a total of 330 instruments, which is basically different stocks, different tickers. Of those, 237 were winners. The actual total positions, so the actual number of trades that were done, is 4,281, with the average days held for stocks at 3.16, average days held for cash equivalent being 58. Average gain 0.91%. Yeah, I went through all this already, actually. So to give you an idea of how the strategy compares to the NASDAQ 100, maximum drawdown of this strategy happened in year 2000, 22.9%. The NASDAQ actually had an 83% drawdown back in the dot-com bubble, which is pretty brutal. Longest drawdown happened in 2015, and it lasted 180 trading days. The NASDAQ was actually in a drawdown situation for 3,900 days. So that's, I mean, I think the NASDAQ just came to a new high recently. So it was basically in a drawdown situation for what, 15 years or something, some crazy amount of time. Average drawdown, so if I take all the drawdowns and just average them out, I get 3.2%. For the NASDAQ, it's 34%. And the average drawdown duration is about 12 days versus 31 days for the NASDAQ. So I updated everything yesterday. So the current drawdown as of yesterday was 4% for the strategy. The NASDAQ is currently at about an 8% drawdown as of yesterday. Last high was on September 2nd. And as you probably know, the NASDAQ on, I think, September 3rd has a few very brutal days. So basically that was the last time we had a high. Return year to date for the strategy is 23%. The NASDAQ about 31%. But even for the month itself, even though it was a very volatile month, the strategy was only down like about 0.9%. The NASDAQ was down 5.7%. The compounded annual growth since 95 is about 39% for the strategy, 14% for the NASDAQ. And so the MAR, that gives you a MAR. If you take the CAGR and divide it by the MAR, the MaxDD, you get 1.72. For the NASDAQ, it's 0.17. If I do an adjusted MAR, I get 2.08. versus 0.17 for the NASDAQ. So anything above 1 for a MAR is considered very good. New portfolio highs, which I consider a very important metric because if you see your portfolio hitting new highs, it gives you hope that you're making money and that things are working. So new portfolio highs happen about 15.4% of the time. And I've calculated all the various risk-adjusted returns, Sharpe ratio, Sortino ratio, Ulcer index. The main thing I want to point out here is that they're much better than the index. So the values that I get for the strategy are much better. So the risk-adjusted return I would consider way better than if I just put money into the index. Okay, and there's a ton of other statistics here that you can find on the website. Things like, how often am I in a drawdown position, greater than 5%, greater than 10%? When was the best day, when was the worst day, all that kind of stuff. If we take a look at the charts, so we have the equity chart here. So this is a log scale of the portfolio equity. We use log scale because of the compounding nature of the equity size. So this allows us to look at it in a linear fashion. And then the drawdown chart. So it gives you an idea of how long the drawdowns last and to what extent, what kind of peaks you're getting with drawdowns. One thing you'll notice is that when you get a steep drawdown, typically the recovery is very quick. Like if I look back to March this year, which would be here, there was a few days which were just brutal. So the drawdown came to, I think, 18%. But then within a few days, it comes back to a very reasonable level, like down 5%, something like that. And finally, we have the return matrix, which is the profit table, which gives you month-by-month returns since '95, and it provides you with what's the average return by month, how many of the months were positive, etc., and what the overall yearly return was. So a few things you can see from here is there's all the years have been positive, and about 70, as I mentioned, 73% of the months are positive. So that means typically out of a 12-month period, you'll have 8 to 9 months that are positive. Okay. Oh, the other thing I wanted to note is that typically you'll have 13 to 14 positions per month based on, doing an average of about 166 trades per year. Yeah, 166 trades per year. So that's 26 to 28 trades per month buying and selling. Okay. Yeah, we talked about equity curve, drawdown. Okay, recent performance. So this is a linear chart starting at the beginning of 2018 until yesterday. So that's a 2.75 years. So the growth over this period was 218%, which is a compounded growth rate of 32.6%. So I started trading the strategy in and around that time. So these are the kind of real results I've been seeing. Okay, automation. Currently, I use the Alera Portfolio Manager to automate trading with the strategy. So my backtest software generates buy and sell signal files daily. And basically what I do is I copy those to a Google Drive, and then Alera grabs the files from a Google Drive. And the APM is configured to execute these buy and sell signals before the market open. And as part of the subscription with SIG, the buy and sell signals are provided, so you can do a direct connection between APM and the SIG website or the Google Drive. Okay, managing emotions. I would say probably the most difficult part of following a trading strategy is managing emotions. Everything is, when things aren't very volatile, it's not too bad because, you don't have huge swings in equity, you don't have huge swings in market sentiment, and, you can basically, things are pretty calm. But when you have periods where there's extended, negative days, extended drawdowns, can be difficult to trade through that. And I'm guilty of it. I'll watch things happen minute to minute in the market sometimes, but it's really not helpful to make money. What I've come up with is if you look at a longer time frame, it can help with smoothing out shorter term fluctuations, and it can give you a better feeling in terms of how the portfolio is actually performing. And you tend to worry a little bit less about the day-to-day and minute-to-minute fluctuations. The other thing you can do is you can compare it to a benchmark and make sure that risk-adjusted return beats it. And the other thing is you have to understand that there will be periods of extended drawdowns and new highs happen only so often. But if I do a comparison between daily and weekly metrics, for instance, new highs, if you look at a weekly chart, new highs are happening 33% of the time, whereas new highs on a daily basis are happening 15.6% of the time. So if you look each week, basically 1 out of every 3 weeks, you're going to be at a new high. Also, the average drawdown tends to be less. So you're not, so the drawdown situation doesn't seem as bad. If we look at the actual data, so this chart here is a equity curve chart for weekly data. So the black line is the new highs. The green line is the actual equity. So any kind of gap here is when you're in a drawdown situation. But you can see that new highs are happening 33% of the time. Where is it? Our current drawdown is 1%, and the current week return is 2.11%, and 61% of weeks are positive. So it can definitely help in terms of managing the portfolio and managing the strategy. Okay, so things I like about the strategy. I like the fact that it has a short holding period. I do have strategies that run like monthly rotation, so you're only doing trades once a month. But if you want to remain more active, this is a good way to stay more active in the market, where you're pretty much doing trades every day, and you can get in and out of trades quickly, and you can cut losses quickly, etc. Secondly, I like the fact that I'm using limit orders, so I'm buying at an advantageous price. And you can see that when prices have a drawdown in the morning, which happens a lot, we can take advantage of that situation. A small number of positions, so it's very easy to manage and it keeps commissions low. We're trading very liquid stocks, so getting in and out is very easy. And the use of market on open orders, this minimizes slippage. And when we're looking at the backtesting versus actual trades, they match almost exactly. Some of the challenges with the strategy, it's momentum based, so things can go against you very quickly. We saw that earlier this month, where I think September 3rd, or first few days of September were pretty rough, and there was a couple days that had pretty bad returns. But then you look at the month itself, and the month was only down 1%. So we're trading more in this, so definitely we're going to have higher commissions. The small number of positions can work against you as well, because if you have a large move in one or two positions, it can have a large impact on the profit and loss for that day. Also, we're out of the market a significant amount of time, so sometimes you might have, fear of missing out, or there might be good times in the market that are not being where you're out of stocks. And the frequency of trades requires a little bit of more hands-on approach. And it is possible that the backtest and actual trades can get out of sync, requiring adjustments. I've had trades fill at very good prices. I've had trades fill in the past where the price didn't even print. So if you look on a chart, it didn't even show that specific price, but I had it filled anyway. So the trade didn't show up in the backtest, but it actually got filled. So you have to go in and adjust the backtest to match. Okay, running multiple strategies. In my research, what I found is that if I use multiple loosely correlated strategies, I can improve performance and enhance risk-adjusted return. So right now I'm running 3 strategies. So the NDX Momentum, which I'm talking about today. I'm running an NDX rotation strategy, which is a medium-term monthly rotation based on NASDAQ 100. And I'm also running a TSX rotation, which is monthly rotation Canadian stocks. I found that the overall returns improve when sharing risk among these 3 strategies, and also the risk-adjusted return metrics improve. So if we take a look at the single versus multiple strategies, pretty much every RAR metric is significantly better. So for instance, the Ulcer index moves down from 4.3 to 3%. We're hitting new highs 20% instead of 15% of the time. The Sharp and Sortino ratios are better. The compounded growth is better. And the MAR ratio is about the same. The adjusted max drawdown is a little bit worse on the multiple strategies, but I'm willing to live with a 1.6% difference there. If we look at correlations between S&P, NASDAQ, and the various strategies, what we can find is that, between the rotation strategy and the momentum strategy, there's only a 26% correlation. And between the rotation strategy, momentum strategy and NASDAQ, there's only a 28% correlation. So I like to make sure that the correlations between the strategies are minimized, so that if I have, if one is not performing very well, the other can take over and balance out the performance of the overall portfolio. If you're interested in more information, you can visit the systematicinvestors.com website, the Mountain Trading landing page. If you want to test drive the strategy, you can take a 1-month trial at $9.99. And for the $9.99, you'll get access to the strategy and the daily signals, and the integration with a Alera Portfolio Manager, which you can use to either semi or fully automate trades. And then on that landing page, there's also the full backtest data, which I update monthly. And then the goal is to do regular webinars to keep you updated on the various strategy developments and new technology to make trading easier and more profitable. So why am I offering trade signals? I feel the strategies are good and provide value to systematic investors. I'm trading these strategies in my own portfolios. I'm not doing this to get rich selling signals. I'm basically looking for like-minded traders that appreciate this type of trading. I don't want to saturate or oversubscribe the system. My main goal is to make money for myself using these strategies and grow my portfolio. Also, providing signals is a good way to do out-of-sample testing of a system and see how it fares in a real trading environment. Because I can put the signals out there, and then over time, basically tabulate how the out-of-sample performance is doing. And the longer I do that, the more data I have. Okay, so to summarize, hopefully you have an understanding now of how the strategy works, some of the expectations if you actually do trade it, how I evaluate performance and risk, how you can use APM to automate the strategy, some tools for managing the emotional side of trading, and the subscription offer from Systematic Investors Group. So if you have any questions after this, you can email me at mountaintradinggroup@gmail.com. And that's it.
Thanks, Gary. That was awesome. Can you hear me okay?
Yep.
Awesome. Okay, so we did have a couple of questions come through, Gary.
Oh, okay.
So let's see. So the first question was, so Phil was asking, so it's basically a mean reversion system.
Yeah. Yep. It
Uh,
looked for pullback, like short-term pullback.
yeah, so I answered Phil and I mentioned it's kind of a combination momentum and mean reversion system because you are kind of ranking first based
Yep.
on high momentum and then buying it at a discount. So would that be fair to say?
Yep. Yeah. Like I said, the goal is to uh, buy stocks that are trending up, hopefully at a good discount.
I like deals, so that sounds good to me.
Yeah.
Okay, so Nabil says, will we get signal to get into cash? So like 51% of the time, I guess, when it's when your main kind of metric tells you to be out of the market, your what would we call that? I guess your regime filter
Yeah.
tells you to be out of the market. You get a signal to get into a bond ETF.
Yes, definitely.
Okay, and I'm pretty sure I've seen that. It just stays every day. The signals get updated, and it just keeps showing, 100% of portfolio in a long-term bond like TLT or the like. Is that correct?
Right. I think we were in bonds. It was a couple months ago, I think.
Yes, I do remember that. It was actually that was right before I started. I actually started trading your strategy with real money after it came out of the bond allocation and it was risk on again.
Right.
So I've
Yeah.
I've been trading it ever since then, and that sounds about right. I'm terrible with time, but it a couple of months maybe.
Right.
Uh, Okay, so Judy says, do the statistics, especially compounded annual return, include brokerage? So I'll let you answer that first because there's a series of questions.
No. So those return calculations don't include commissions. But that's why I always look at how much it's costing relative to the portfolio. So technically you could, if you know what your overhead is in terms of commissions and, SEC fees, that kind of thing, you can adjust the compounded growth by that amount. So that if it's 1% is your overhead, then you can adjust the compounded growth by 1% to incorporate commissions.
And I think you said, Gary, if I remember correctly, if you were, let's say, imagining you were trading with a $50,000 account, your commissions and overhead and slippage were about 0.75%. That's about right, isn't it?
Yep. let me just, where is it here? Is my, is it still showing up?
Yes, you're still in charge of the screen. Yep.
Okay, 1 second here. Yeah, it's, yeah, right here. So if you have a 50K portfolio, the commission is estimated, if you're trading through interactive brokers, typically I'm finding that round trip commission will be about $2.25. So if you add all that up for a year, typical year, to be about $375, 0.75%.
Perfect. Okay, and then let's see. There was another question also on what size is the portfolio tested? I assume she means. I assume Judy means for the actual back test.
Well, I use a $10,000 starting value, but it doesn't really matter because everything is relative.
Mm-hmm.
Because everything is based on percentage change, not absolute dollar change.
Right. And then finally, Judy asked, do you have the statistics for the last 3 years? I think probably the best thing that I saw was your profit table, which shows the returns over the last since 1995, I guess, but it will show the last 3 years in there as well.
Yeah, so last 3 years would be here, 2018. So 27%, 38.9, 23.1. And then the other thing was the recent performance.
From 2017. So you've been trading this system for about 3 years yourself.
Yeah, I think it's been 2.5 years.
Okay. Yeah, I think I remember when you started trading it, we had talked about it, and you were pretty excited about it.
Yeah.
And I was excited about it too because it sounded really good. And now I'm trading it, so that's great.
One thing I wanted to point out here is just how volatile the last year's been.
Mm-hmm.
This year's been crazy. If you look at like just the variation in portfolio value.
But the
Like it's
drawdowns
trending.
have been pretty quick, right? Like, I mean, they've recovered really quickly.
Yes, they have. If you look at the drawdowns recently, so this was, March 18th or whatever that was. This right here is March 18th, I think. But recovery from that was very quick.
And that ties into your, I think, into your 3 tips for getting rich is not to panic, right? When things
Right.
go bad, just let the strategy do its thing and don't panic.
Right. It can be really difficult, but
Yeah, no, I mean, I totally agree. I mean, that's the challenge of being a systematic trader, right? Is, you've got 20 or 25 or 30 years of data, and your impulse is to try to make a decision in a split second and fight like 25 years of data, right?
yeah,
And that's not always a good outcome when you do that.
right.
So yeah, I'm with you there. Okay, so Graham says, asks rather, do the parameters for the system vary over time? That is, do you need to re-optimize the strategy periodically?
What I found is that um, it's really drawdowns that I look at because they can be so difficult to manage. What I've done over the past year is I adjusted the regime filter, like the macro filter, a little bit to be a little more conservative. So I added a volatility element to the macro filter, the regime filter, because I found that if volatility gets extremely high, you don't really want to be trading stocks,
No.
just because the moves are so crazy, and it's much more. It relieves a lot of stress if you can just go back to cash, right? So I added in a volatility component to the macro filter. In terms of the rules for like momentum rules and stuff like that, I'm not planning on changing them because they are pretty general rules. Like it's basically a rate of change over a specific amount of time. So it's adjusting them a little bit here and there is not, I've found in my experience, does not have a huge impact on the overall performance.
Right. It's fairly robust, and you don't really have a lot of parameters to change in the first place in terms of, your rules are fairly simple and robust,
Right.
essentially.
Yeah. And
Yeah.
because it's a short-term strategy with a stop loss, if there's a losing trade, I get out of it very, very quickly. Like I've had a number of trades recently that, went against me the first day and I just sell it the next day. I mean, one of the keys to a strategy like this is you have to be willing to lose, and you're going to be losing 49% of the time. But the key is that your winners far outweigh your losers. So you're
You got to become a loser to become a winner.
right. And like, as you know, Dave, the
Yeah.
strategies that have a good expectancy or a good overall performance tend to have a lower win ratio, right?
Yeah,
Win
absolutely.
percentage. And
Absolutely.
like a strategy that has an 80% win percentage, the winners are gonna be slimly or very close. They're going to be very close to the losers in terms of returns.
Yeah, and I think that's a good point, Gary, because a lot of people don't realize you basically have two aspects to any kind of trading. Like you're either going to win, you're going to win a high percentage of the time, but you're going to win a little bit, or you're going to win a lower percentage of the time and win a lot more when you do trade in terms of your returns. Like I guess the examples would be a short-term mean reversion system with a high win rate and a lower return versus a long-term trend following system, right? Where you're
Yeah,
going to get like a 30% return or win rate rather, but you're going to get, your metrics in terms of your profit factors and your expectancy and things like that are going to be much higher.
right.
And also, like, I mean, that translates even over to how a lot of people are, doing this, doing option trading, where they're selling premium and they're winning 8 or 9 times out of 10, and they're picking up small amounts of wins, and but the wins are very small, right?
Right.
Which opens you up to, can open you up to a nasty drawdown the times that you do lose. Um,
Yep.
so I mean, yeah, I mean, I totally get it because I've looked at enough back tests, and hopefully, our audience out there, if they don't get it, if they're new to systematic trading and they don't understand that, that's something that, we teach within the community. So, I mean, stick around, join us, and you'll learn all about the realities of trading, because it doesn't just apply, it applies to almost any investment that you could think of, right? I mean, it's just, I ran so many back tests, and I always tried to find that trade, or that strategy rather, that would give me a high win rate and a high return per trade. And it's always a trade-off, always.
Yeah.
Okay, so Marcel asks, hi Marcel, when you oh, sorry, I skipped one. Sorry, I'm gonna back up to Nabil. So Nabil says, that's how we get the greater than 60% returns in 2008, right? Using TLT.
That's correct. Yep.
Okay. So Marcel says, when you backtest the system, do you code it to prevent index constituent bias? Marcel, I think you're going to need to specify what you consider, Gary, unless you understand that, what
Um,
index
I think,
constituent bias is.
well, what I did was I went back and recreated the index uh, accurately back until 1995. So whatever the index looked like at that period of time, I make sure that that's what's being traded,
Right.
and that
So
I have the historical data for those stocks, even if they're delisted stocks.
Right. So it makes use of index constituent bias and what stock tickers were a member of the index at that point in time.
Right.
Right.
Yep.
So Marcel, if that's like, because Marcel is, I know Marcel quite well. We're both part of the Emmy broker community, and Marcel, I think you could relate it to, it's similar to using Norgate data, the way Gary does it, so that he does have the index constituent data, and it does get incorporated into the cell rules, so that there's no survivorship bias. Yes,
Right.
okay, that's what you're
Yep.
referring to. Okay, yeah, he absolutely has done it correctly, Marcel. Yep. Okay, so PB96, I guess that maybe is your rap name. Um, just joking around here. How does the reentry order signal look? It's intraday, but you say the signals are end of day.
So the re-entry order is entered before the market opens, but it's a limit order, a buy limit. Um, so in Alera Portfolio Manager, there's a re-entry order that you can put in. So if you have, let's say you have Tesla in your portfolio, and it's being sold at the open using a market on open order, but then you also have it still ranks high, so you have a re-entry order for Tesla as well. So in Alera, I would put in a sell order and a re-entry order. And basically what happens is once the sell order is executed and Tesla is out of the portfolio, then the re-entry order becomes active, and the re-entry order turns into a buy limit order. So the buy limit order could fill at some point during the day, or it could just expire.
I was just looking in Alera Portfolio Manager to see if there was a reentry, an REL order in there today, and there wasn't. Okay.
No, there wasn't.
Okay, so let's say Graham says, does the long-term backtest include the new volatility macro filter for the fill period, or only for the time since it was implemented? So I guess that would actually tie into one of the previous questions too, is when you do an adjustment
Yeah.
to any of the parameters, I guess you rerun the entire backtest, right?
In that case, the change was only done for the recent, since it was implemented.
Ah, okay, that makes sense.
So I didn't go back and adjust the macro filter based on the volatility.
Right. So that's actually a good point, because if there are any adjustments in the strategy going forward, I mean, it'll just reflect in whatever signals you're putting out, so that it's not like you're recreating the performance going back in history. It'll be accurate as to what was the expectation at that time, right?
Right. Yep.
Which I think is an honest way to do it. Um, Okay, so hopefully that answers your question, Graham. Good stuff. So Marcel, okay, we covered Marcel's point. So maybe Gary, if you want to just maybe stay on the line and just let me share the screen. If you
Yep.
can stop sharing, what I'll do is I'll just show everyone just a quick demo of how they can get the signals. Okay, so let me just share the screen here. Screen number 2, share. Okay. So let me pull up my websites in the background. Okay. Okay, gang. So I just want to kind of explain, because we get a lot of confusion about this. So there's basically 2 ways you can get signals. So let me start with the first way. So on the website, if you subscribe to Gary's service, his service can be found under the membership levels called Mountain Trading. So we're hosting Gary's stuff for him here, because I mean, I had to kind of twist his arm to make this stuff available to the community, because he likes to focus on strategy development. He doesn't want to have to worry about all the all this marketing stuff and all this website updates and stuff like that. So, and I don't blame him. I mean, it's a lot of work. So so we're hosting Gary's stuff on our website. That's why it's actually a separate service, right? So you can almost look at this as a mini site within our site. So Gary's Mountain Trading Company, you can come here, you can look at his story, his main strategy. You can subscribe to his signals here. but I just wanted to show you like how you can get his signals delivered, right? So if you come over here to view, if you have a subscription and you come over here to view daily strategy scan, it will pop open this screen here. And what it does is it will show you a buy scan and a sell scan. So for example, what this is saying is this was the scan for yesterday, which is actually active today. So this is automatically generated for our members. Today is October the 1st. These were generated at the close of yesterday and available at 4:30 this morning before the market opens. Now, so what happens is this is saying, okay, you can buy to open Zoom with a quantity of 20% of the portfolio that's allocated to the strategy at a limit price of 462.68. So if you wanted to, you could come as early as 4:30 or 5 in the morning, or as long as you get your orders in before before 9:30 a.m. Eastern time, New York time, then you're fine. So you could come in here and you could run this manually, right? You could come in here and say, okay, I'm going to buy Zoom. I'm going to buy to open Tesla with 20% of my portfolio. I'm using a limit price of 423.90. And then what it'll also tell you is these are all the things that you need to sell if they're in your portfolio. Now, the reason why there's so many sell orders is because these are the same signals that we use for Alera Portfolio Manager. So the first level is that you can look at these signals and you can try to manage them manually, which is fine. Now, the second level is we provide we call these strategy scans, and we provide these strategy scans in a different format, which can be used with our automation software platform of choice called Alera Portfolio Manager. Now, Alera Portfolio Manager is quite unique. I don't know of anything else like it in the market. And what it's designed to do is it's designed to allow you to basically automate, semi or fully automate your strategy signals from almost any source. So in this instance, we're not generating the signals locally, although Gary can generate his signals locally and trade with his local instance of Alera Portfolio Manager. But what in fact we're doing is, if you look at this little G Drive folder ID, this little, well, not little, but this long string of cryptic characters is basically what you just copy and paste into Alera Portfolio Manager in this line here, once you've been given access to the strategy. And what that allows you to do is every day, it will just, these are the actual same signals that get driven directly into Alera Portfolio Manager. So the way that works is you don't really have to do anything. All the signals come in here. Even there was a question about the reentry orders. They all come in here as well. They all get managed and handled automatically. So Alera will just come and it'll pull the signals every single day. So for example, you can come here and say, just click a quick button and it'll show you what signals were generated for that day that need to be traded. So the other thing you can do is you can do an order preview. Now it's not going to, it's usually not going to show me much unless I have orders. But so what it'll do is it'll bring up a list and it'll say, these are the things that you should sell and these are the things that you should buy. And it deduces this based on what you actually have in your portfolio. And then you can decide if you actually want to skip the trades or if you just want to let it do its thing. So you could actually just pull this up every day. You could just click a button here, this little play button, and it will just trade it for you. It'll trade for you based on what you actually decide to trade. So for example, if I wanted to trade all of these, I wouldn't skip any of them. And I would just say, yep, I'm happy with those. I'm happy with these. In fact, if you want, you can even click on the ticker symbol. You can click on the ticker symbol and you can see what the charts look like, right? It'll take all of those ticker symbols, it'll dump them into a little watch list, and you can just scroll through it and you can see, oh, okay, here's what the chart looks like. Okay, mRNA, yep, I don't really like that one. Zoom is on fire, yep, I like that. I'm going to buy that one. Tesla looks pretty good, even though it looks like it put in kind of a double, it put in a lower high here. But if we, it looks like we have a higher low, so maybe it's going to work out, right? So if you want to use a little bit of discretion, I personally don't suggest it, but everybody has their own way of doing things. So you could say, okay, yep, I want to trade that, which was the one I said I didn't want to trade. I think it was MRNA. You can just skip that order. You can update your list. And then what you could do is actually send it to the market just by hitting this little play button, and it'll just run, and whatever ends up in your portfolio will show up here, right? It'll actually just, when it's live, it'll show up in your portfolio, and then you can actually, watch what your portfolio is doing. And the other thing you can do is, this is a new feature that's been added. You can look at, well, this is not a new feature, but it'll show you what was traded today. But it will actually, when you start running your strategy, it'll start plotting your equity curve based on your real P&L at the end of the day. So you can start seeing, how is my strategy performing? This blue line, how is Gary's strategy performing over the last couple days versus our benchmark, which in this case is the SPY. Well, the SPY is a little bit ahead of us, but I'm pretty certain, based on the backtesting criteria, or based on the backtesting results over the last several years, that Gary's strategy is going to overtake the SPY. And over a couple of months, over a year, you're going to see, a well-formed equity curve. But this is a good way to see how this individual strategy is performing. So Alera Portfolio allows you to basically grab all of those signals that Gary's making available every day. You can trade it semi-automatically, or you can trade it fully automated, which is what I do. And it just, it just runs a strategy every day. I don't click any buttons. It just does its thing. And I don't have to deal with the emotional impact, which I always, that's been one of my big challenge points, is dealing with the day-to-day emotional impact of deciding, should I take this trade? Should I get out of this trade? Should I sit in front of my computer instead of taking my daughter to school, which is not a good thing to have to decide. So that's where it comes in handy. Now, some people don't like automation, and that's totally cool. When you start running multiple strategies, it's going to be a challenge. But if you just want to run Gary's strategy, you're managing 5 positions a day, that's cool. You don't have to do it. However, when you subscribe to his signals, you get both. You get both options. So we make it, super simple for you, depending on what your preference is. Now, just to show you just a couple other things, I'll show you a strategy that we offer through Systematic Investors Group that just has more positions because of the nature of the strategy. It will hold up to 20 positions, just so you can kind of see what you can do here. Like, you can just kind of sort your strategies by percentage gain, and things like that. You can see the orders that are in the market, things of that nature. Again, you can see the P&L curve, which starts plotting when you start running your strategy. So that's essentially, in a nutshell, and a really quick demo, what you can do with Gary signals, which, his strategy has been performing really well over the back test and in forward testing, or rather in out of sample testing. So like we just started, these were some new features in Alera. So we just started tracking this about 6 days ago, when the update became available. So this is something we're pretty excited about. So sorry guys, hopefully that all made sense. If you have any questions about, how you can access the signals, how you can execute them in real time, whether you want to do it manually, semi-automatically, or in full autopilot mode. If you guys have any questions about that, let me just check the Zoom chat. So let's see. So let's see, how far back do I go here? So Marcel says, yes, exactly. Okay, we did that. He's done it correctly. Excellent presentation. Thanks, Gary. Thanks, Dave. You're welcome, Marcel. You're absolutely welcome. So Graham says, limit sell orders were not discussed in the presentation, only market on open. How do limit sells fit in? Gary, do you want to take that?
Sure. So I put in limit sell orders when I open the trade, um, but it's really just a long shot profit target, and it rarely gets hit. But I've found that in the back testing that if I do have a sell limit at some high price level, the odd time it does hit, and it improves performance a little bit. So, for instance, if you take the um, if you take the orders for, oh, actually, if we look at the sell orders on the right side, like PDD, for instance, the limit is at 93.11. I think PDD closed today at I don't know, $77 or something like that. So it's $16 higher than the close today. So the chances of it getting up there are slim, but it does happen every once in a while. I think like 0.1% of the time, those sell limits are actually triggered. Um,
And those will show up right in your portfolio, Graham. Sorry, okay. So those will show up right in your portfolio. Like when the market opens tomorrow, all of those sell limit orders will show for the active positions. It'll just drop the order in here to sell at a limit. And if it gets hit, it'll execute. And if not, it'll go away at the end of the day, right? Because the time in force is just a day order.
yeah. And the other part of that is that if you, Dave, if you go back to the website,
Mm-hmm.
you'll notice that there's three sell STC orders. So sell to close, and then the remainder are close orders. So the reason I do that is so that you can tell the difference between what's currently in the portfolio and what is just being closed to get rid of any stray symbols.
Right. Just to sync up your strategy in case
Yeah.
anything's in there.
So the STC orders here, um, by adding those in, it allows you to see what's currently in the portfolio as
Makes
well.
total sense. That makes total sense. Yeah, because you throw out limit orders for everything that's in the portfolio, just in the off chance that you're gonna get hit at a super duper profit, right? So
Right.
and how often does that happen, Gary?
I think it's 0.1% of the time. So
But it's still worth it, right?
there's been like what 4,000 something trades. So that's like 40, what,
So
four
once in a
times.
while you're gonna get a real home run.
Yeah. I mean, I had one recently that almost hit that limit. It was Meli,
Oh,
MELI,
okay.
Mercado Libre.
Hmm.
And so it can happen, and it will happen at some point. It's just not going to happen very often.
Awesome. So Graham says, does Alera give a trade history listing for each strategy? So what Alera does is, I mean, usually your backtest will give you a history of your trades, but what Alera will do is it'll send you an email every day of everything that's transacted or everything that it's tried to do. So you can turn on the email features within Alera Portfolio Manager. Um, Let me just show you here.
There's also the log, Dave.
Yes, and there's also the log. So the log will show you, what it's attempted to do. And I think does it also keep a long-term log? I believe it does. It keeps a long-term log as well, because this short-term log gets reset every time if you restart the program. But it does keep this log. It will send you emails to tell you exactly what it's done. I keep the emails on because if I've got my system running in full autopilot and I don't receive an email, I know something's wrong and I need to intervene. So I like the emails just to see what it's kind of doing. I actually don't even really pay attention to what it's trading anymore because I've developed so much trust in the strategies. I used to, just go through the email, go through the log every day, go through the software, and I used to look at the charts of every single thing it was going to buy or sell. I don't do that anymore. I usually just kind of skim through it and let it do its thing. But there's a number of ways that you can look at everything that it does. It doesn't present it to you like a backtest would in a concise list like that, but it does kind of give you an indication of what it's doing. So Marcel says, so I hope that helps, Graham. Gary, is there anything to add to that? Did I leave anything out or?
No, that was
Okay.
good.
Okay, so Marcel says, with full automation, how can you give it access to your Interactive Brokers account? Don't you have to go through all the complicated login? No, actually, the way it works is now I don't know if it runs with two-factor authentication, but I don't. I don't run my my automated account with two-factor authentication. So what you do is you just you set up your account details here, right? Um, and this is my paper trading account. So if anybody wants to dump any money into my account, that's totally fine. So you set up your credentials. You set up your credentials for your account here. It actually doesn't have any password information here, but what it does is it connects to IB Gateway. So what you do is you have IB Gateway running in the background, which is just this lightweight API that Alera connects through, and you log in here with your credentials through IB Gateway. I'm sure you could probably use two-factor authentication for IB Gateway, and
Yeah, you
just like,
can.
yeah,
No
you
problem.
can. Okay.
I use it.
Okay, you do use it. Okay.
Yeah.
Sorry, I probably should ask you, Gary. When I set mine up, I didn't. I should probably put it on my account because it's safer. And then this is what actually gives you the connection to IB, to Interactive Brokers. Alera Portfolio Manager connects using your settings and your account ID directly through IB Gateway, but all of your sensitive data is handled directly by the broker, not by Alera. And Alera just connects to it. So that's why I can have, I've got a live trading account open on my computer, and I've got a simulated account. And if I actually wanted to run like 10 accounts, I could run 10 instances of IB Gateway on my computer and 10 instances of Alera Portfolio Manager. And like you can see, this one is called AMI Broker. It's just the name I gave it because I was running AMI Broker strategies through it. But I've got another one called Production, and that's all my production stuff. And I could have another one called, Marcel lent me money, and that could be my account, like my desktop name, and you can run multiple accounts, and you can run multiple strategies in each account, and so that all gets handled directly through, the connection to the broker, which happens through IB Gateway.
And
Sorry, that was kind of a long answer
the
for
other
us.
thing to mention is that Alera does a reconnect each night.
Mm-hmm.
So it'll maintain the connection for a week. You're going to have to go in on Sunday to re-log in.
Yeah, and that's because Interactive Brokers, IB Gateway, resets its servers over the weekend, and then you have to reconnect once a week, and that just really entails logging in, right? So all you really do is you come over here, your Alera Portfolio Manager will still be running, but what will end up happening is this will go down. So you just double click on it, open it up, put in your login credentials, start it up. Alera Portfolio Manager will look like this. So you'll see that it's red and not connected. And basically then all you do is click start, and it will connect to IB Gateway, and you're good to go. I mean, it literally takes like less than 30 seconds, unless you forget your password. Okay, so I hope that answers your question, Marcel. I think the two-factor authentication works with an app, IBKR app on your phone, right? Is that what you use, Gary?
Yep, it's actually very easy.
Yeah,
It's way easier than using the. I used to
old,
use the cards for the two-factor,
right.
where they give you all those codes, but the two-factor on the phone is really easy, and you can
Yes.
use fingerprint to authenticate, so it's very secure.
Yep, that's exactly what I do with my main account. That reminds me, I probably should put two-factor authentication for my specific trading account. I probably shouldn't let people know that's how it's set up. Okay, so Marcel says, so to make sure you have everything working right, you could start out for the first week or so with the Interactive Brokers paper trader. Oh, absolutely. So if you go to our website, for anyone who's interested, you don't even have to pay for this to get started. What you can do is if you go to our main site, just click on the logo here, go to our main site, and on the very front video, this video here will take you through the process of setting up a paper instance of Alera Portfolio Manager, which is what I'm using right here to test strategies. Right here, this is a paper instance. You can see it's simulated trading. This is a paper trading account, no money involved. And this will take you through that whole process of how to get the free instance of APM, but it'll also give you access, and it'll tell you how to get access to our 2 free trading strategies, so that, when we started this, we figured, like, look, we've got to give people a way to try this, because it seems like there's a lot of moving parts, but it's actually quite simple. So for example, if you come over here to free daily trade ideas, these are 2 strategies that I've developed, and I actually trade them. I trade them with my real money. So the 3 strategies that I'm trading right now, I'm trading Gary's NDX Momentum Strategy, which is a premier pro strategy. Obviously, you're going to have to pay for it. It's worth every penny. But we also offer 2 free strategies to get started. One is called the RSI 2 pullback, and the other is called the supercharged momentum trend strategy. Now, we've done strategy sessions on both of these, similar to what we're doing today with Gary's strategy. We've got, the scans are available. We've got, once you're ready to set it up with APM, you can click on the APM settings, just like you can with Gary's strategy. And it'll tell you exactly how to set up all of these screen settings with the Alera Portfolio Manager. So what do you put in this field? What do you put in that field? What do you put here? What do you put there? All of that stuff is, we just show you basically how to set it up. So if you want to get started, Marcel, the thing I would suggest is, if you want to get started with the technology, just come over here on our main page, watch this video. It's about half an hour, but it's very detailed because it takes you through every exact step you're going to need. So I hope that answers your question. Graham says, is there a new version of Alera with P&L tab, or is yours a beta release? No, there is a new version. So if you just come over to, here's the version here on the Alera Trading website. So the way that you get to that is you just go to Alera Trading, you click on products, and then you click on register and download. And because I'm already like auto logged in because I set up an account through the forum, you'll just have to go and set up an account through the forum. It'll take you to this page, and this is where you get all of the latest versions of the software. You just click on this, and you download it and save it and install it. And it's all explained quite clearly in this video. Although, from the time you create a video to the time when certain interfaces sometimes change with software, but it should be pretty accurate to what exactly you need to do. So just watch that video, Graham and Marcel, and it'll explain everything you need to do. Yeah. So gang, I mean, we've been going here for, wow, about an hour and 40 minutes. Usually we keep this to just, about an hour and 15 minutes. So are there any other questions that anybody has for us? I mean, if you need to get in touch, Gary, do you want to maybe just drop your email in the chat box there in case anybody needs to get in touch with you? You can also get in touch with them through the website about the strategy. Now, just one other quick thing, guys. So if you want to access Gary's backtest results that he was showing, you can just click over here, view current backtest. So again, that's under membership levels, Mountain Trading. You can click over here for the current backtest, which will show you a new window will pop up. I've set up the site to pop up new windows so you don't kind of lose track of where you are. But that'll pull up all that information in a separate page. I apologize, the website's running a little bit slow today. But so that'll give you all, some of the strategy logic. There's a little video here for that as well. Backtest assumptions so that you know what's going on. Five positions, 20% per portfolio. This was the start date. We're equal weighting. Here's all the strategy metrics you can go through, which is very cool. You can look at the charts that Gary was showing you. You can zoom in. Here's the profit table. So all this information, all the information, gang, is there. And the other thing that's going to happen is once this is, one other thing, the APM settings to set up the your Alera Portfolio Manager, you just click on that and it will show you what all the settings are, and it'll show you some of the things that you may be able to change and the caveats for changing those. So it's all explained. It's all explained in detail here for every strategy. That's where you can get Gary's. And the other thing that'll show up here maybe tomorrow or the day after is a copy of this strategy presentation so that you can go through the strategy presentation in detail. So I hope that helps. So gang, I don't think there's any many other questions. Richard says, what are the options and the cost for these services? So for Gary's strategy, if you subscribe to his signals, what you're going to get is the first month is only $9.99, and then it will roll. If you decide to keep it, it will roll into a month-by-month subscription, which is, I think is it 75, Gary? Yeah, 75 a month.
Yeah.
So 1 month for $9.99, then $75 per month, and I mean you can cancel whenever you want. There's no commitments beyond 1 month. And the prices are all US dollars, guys. Just so that you know, the prices are in US dollars. So, I suggest if you want to check it out, set up the free system based on the video on the front page, and then try Gary's signals for $9.99. And then, you can start tracking the performance. It'll give you an idea of how things work, how to automate your own stuff. I don't want to toot our own horn, guys, but we spent like 2 years getting this structure in place so that other systematic traders and investors had an easy way to share strategies. And because it's very difficult to come up with your own strategies, but also an easy way to actually be able to implement. And this is something that we do better than probably anyone else. I mean, you guys all know there's other guys out there that I have a lot of respect for that do systematic strategies, but what we actually do is take it a step further and we help you implement, right? And that's really where the rubber meets the road, because I know a lot of guys, I mean, in the AMI Broker Canada group, we do this. We look at tons of strategies, but at some point you actually need to execute those strategies. And I can tell you, I've got 3 strategies running. Gary's got 3 strategies running. Our colleague Dan has probably 7 strategies running. My goal is to get at least 5 strategies running by the end of the year. I mean, it's very difficult to do that manually if you want to have a life, right? You're trying to switch gears between managing multiple strategies and consistently being in the market every single day without fail. This is the way to do it. So it makes a lot of sense. Now, if you want to look at our full membership options, you can have a look at that. It's all here on the website as well. But if you really want to get started with a good strategy, I can tell you Gary's strategy performs a lot better than my strategies do. So that might be a good one to get started with. And it's fairly easy to manage. So with that, I hope that answers your question, Richard. With that, like I said, we've been going for about 1 hour and 45 minutes now. If you guys have any other questions, you can follow up with an email. Like Gary suggested, at some point, we'll be doing webinar updates to keep you guys updated of all relevant, major updates. In fact, that's something that we're planning to do, on a monthly basis on various things based on strategies, based on education within the community. Now, the other thing, if you haven't seen it yet, guys, just have a look at our blog posts for today. It kind of goes through the upgrades for Alera Portfolio Manager. I just put this out a little bit earlier today. You probably got blasted with a bunch of emails as well, but you can just go to our articles and blog posts and you can find just a kind of an overview of the P&L chart and some other cool new features that just came out in Alera Portfolio Manager. Okay, gang, so with that, I don't see any other questions rolling through. You guys could have been anywhere tonight, but you chose to be with us. And for that, we're really appreciative. We really appreciate it, guys. Everybody's time is valuable. I think your return on your time and your educational investment tonight in trying Gary's strategy would pay off really well. And I can say that because I'm running a strategy with my own real money. So, we kind of drink our own Kool-Aid around here, and that's what I believe, and that's what I'll say. So gang, you could have been anywhere tonight. You chose to be with us. We really appreciate it. Gary, I want to thank you so much for spending the time to put your presentation together, for sharing it with the group to begin with, because I knew you could just sit at home and just, like you said, you're not going to get rich off of selling signals. You want to be part of our community. You want to share. Gary and I get together every once in a while. We actually live pretty close together, and we've kind of come up we've come up in the same sort of trading circles, and we've been friends for a number of years. So we get together. I think we got together last week. We get together for lunch once in a while. Guys, if you want to be successful at this stuff, you gotta have the right friends, and you gotta belong to a community of people that know the struggle, and they're focused on the same things with you. So if you want to go far, you can go alone, but if you want to go fast, you can go alone. If you want to go far, you should go together. So hopefully you'll join us, and we'll do this together. So, yep. So Gary, I think you turned off his mic. Thanks again, Gary. Thanks, Fez. Thanks, Richard. Thanks, Dan, for coming on. Neil, Omar, Richard, Ross, Judy, Marcel, MF, Judy. I said Judy. Joseph, Graham, Fez, Dan, Gary B. Thank you again. Thanks for sticking with us to the end, guys. And we'll look forward to seeing you guys on the inside or at another strategy session coming up quite soon. Good night, everyone.